So we're going to be moving to our final keynote presentation for today. We're going to be talking with Karim Raffa, Director of Strategy and Ventures at Digi-Group in Singapore. Karim's career in finance started in 2013 as a broker in London, and he moved to Singapore in 2015, where he started working for Tethys as a Director of Operations. Karim reached out into independent consulting in 2017, offering consultancy services to startups and SMEs. And in 2018, Digi-Group approached Karim to launch its venture builder, which he now manages projects ranging from treasury systems in banks to government grant management systems. He's going to be telling us today about one of the most challenging questions that startups face, namely, how can I possibly evaluate the company? So his topic today is company validation. Karim Raffa. Let's see if we have Karim on the line.
Yes, hello, can you hear me?
Hello, Karim. Welcome to
Hi, Douglas.
From Switzerland and Singapore. But it must be something like 6, 7 in the evening there.
Correct, 6 p.m. here, getting somewhat late, but we're doing okay.
Okay, very good evening to you then. Let's see, I don't see your presentation yet. Let's see if we're going to get it up.
Sorry, how about now?
It might be just me, but I will check with our support team if his presentation is working.
Nope, not
yet. Thank you, support team.
Sorry. Not exactly sure. This was working earlier, so.
As always, it always runs in it always works in the test run, but rarely in the live demo. So maybe is your camera, have you seen your camera icon, if that's clicked on?
That is clicked on.
Okay. And I can hear you very well, so that's already an improvement.
That's a good start. Sorry about this.
We just don't see the presentation.
Should be fine.
Okay.
Everything's green.
Okay. On our
I believe you have my presentation though. If you want to click through for me, that should work as well.
Let's see if I can ask Lisa or Tanya about that. And we can put up his presentation and then we'll simply walk through it.
That's unfortunate.
One of the joys of live presentations. Okay, there we go. We're up and running with your presentation. I see the opening slide with valuations, World Innovations Forum, and
fantastic.
Yes, that's good, with your email address. So Karim, I think at this point, I will hand over the floor to you. You'll simply need to announce when you would like the slide advanced.
So yeah, so I'm here to talk about valuation today. And like you said, how can you possibly value a company? Thank you for that lovely intro. Like you mentioned, I work for a venture builder in Singapore. What we do is we find value in new marketplaces that require a technology from other marketplaces and implement it there. So we basically increase market reach for smaller companies. To go to the first slide, please. Or to the second slide, actually. Thank you. So why are we here to talk about valuation? So first of all, it's all over the news. You can't really turn on your TV without finding that someone raised 5, 10, 15, 100 million or $1 billion. Even when it's not on the news, it's on the news. If you're looking at stock prices, if you're looking at anything price related when it comes to equity value, it's on the news. And it's fundamental. It's really as fundamental as it gets. The value that you attribute to anything, be it equity, be it a good, be it a service, that's the basics right there. It's often misunderstood, and especially when it comes to private companies. We'll get to that. And it cares a lot about what you think. Believe it or not, it's fickle that way. And it also doesn't care if you're right or you're wrong about it when it comes to the fundamentals. And the next slide, please. Now let's get back to basics. Supply and demand is key. The more there is of anything, the less people are going to ask for that one particular unit of that good, and the less it costs, or the less the value is. Investing in things you love is how it usually starts. If you have a watch, an heirloom, a car, art, ideally what you want is for that product or that good to go up in value over time. Now the market predictions in this case is that it's rare, You love it, other people likely love it, and that's what means that it's going to go up in price. Now you want to adjust for inflation as well, because, well, as everyone knows, the value of a currency decreases over time, and you don't want to get caught out that way. And in the end, hopefully, there's a profit strategy. And most of the time, that's selling that good, or in the case of a startup, it's exiting. Now the next slide, please, and we'll get to the math. Now, calculating valuation, do bear with me, this is a messy and pretty big slide. There's a few techniques, and they're all right, they're all wrong, and it really depends entirely on you. Number one is market cap, which is the share price multiplied by the number of shares outstanding, which is a very basic one, and please remember this one because we're going to use it quite a bit. Second one is a times revenue method, which is pretty much forecasting revenue streams over time and then applying it by a multiplier, depending on which industry you're in. If you're producing batteries and someone else produces batteries and they grew by this much by 10x over 10 years, the odds are pretty high that you'll be in a similar sort of marketplace. Discounted cash flow is the one that all of our startup founders here love, because that's usually what you put in your first data room, which is just forecasting revenues over a period of time and then discounting it to your current net present value. A book value is basically just your total liabilities minus your total assets, pretty much what you're doing your checkbook once a week, once a month. Liquidation value is pretty much what a company is worth if it goes bankrupt and it has to sell off its assets. And enterprise value, I'm sure you will have noticed, is the first one, market cap, minus the book value, or plus the book value, sorry. Let me go to the next slide, please. Now, this is one of my very favorite charts. This is the British Petroleum charts during its oil spill back in 2010. Now, supply and demand here is fickle, because you can see the market overreacts, drops suddenly, and then corrects itself for the following 6 months to a much lesser volatile gap right there. That is because the short term, people are uncertain, they're scared, there are rumors, and no one really knows what's going to go on, so they overreact. But over time, the true value, the book value, the enterprise value, all of these things take over again, and it corrects over time. With the next slide, please. Now, I'm going to push on demand even more. Now, tweets and other news articles are important. This is a great article from back in 2013 when the Associated Press got hacked, and a fake tweet was sent out saying that the White House got bombed, and the Dow Jones dropped, was 1,000 points in a day, or 100 points in a day. And then it corrected instantly because the news was fake. Now, it's like the president like we have in the US at the moment, everyone knows what the impact of a tweet can be in the long and in the short run. These are all opinion factors, and they all affect value. Go to the next slide, please. Now, this is where things get fun and even more complicated when it comes to private companies. So for all of you founders and VCs out there, you know exactly what I'm talking about. If it's an early stage startup, how do you know if it's a good investment or not? Now, if you're talking to some of these seed and pre-A round VCs, they'll tell you the founder is everything. If the founder has a good track record, good personality, and he was kind to me when I first met him, that's usually good enough. Now, for everything later than that, B to say F rounds, the fundamentals say mix something of discounted cash flow, EV, liquidation value, and a market multiple. And you should know where a company that makes electric cars goes based on, say, Tesla's stock price. Now, it's always quite subjective, and it depends on the investor, because you still need to include a discount rate, which is pretty much up to the person calculating. You want to inflate forecasts, cash flows, etc. That's all entirely up to the startup presenting their data room, but also how critical the investor wants to be. This is all part of that due diligence. However, next slide, please. This was meant to be more dramatic. However, traditionally, the valuation of a startup starts at its first investment. If you give away 10% of your company a certain value, that company is going to be worth 10 times those 10%. The bigger and more trustworthy that first investor is, say SoftBank, for example, the less stressed following investors are going to be about calculating your current company's valuation and carrying out their own due diligence. It seems like a good idea, because if you throw $7.5 billion at WeWork and call it a digital co-working space with endless scaling opportunities, well, it's $7.5 billion. They must have thought this through, right? And you do the same thing for a dog walking app or a pizza delivery app, right? And you end up with valuations that are $47 billion, $650 million, all based on that first investment. Next slide, please. So that first investment really does determine everything. The one thing that does happen is that these companies get reality checked. Traditionally and historically, looking at WeWork once again, because it's an easy one, it's quite recent, just December last, when they IPO. So first of all, when you want to IPO, the exchange on which you want to list your company has a bunch of due diligence questions and tick boxes to hit. And if you don't really hit them, they're going to start asking more questions. Secondly, once you do actually list, looking at Uber, for example, the public and institutional investors and the masses, and all in a very easy buy and sell scenario, will determine what the demand for your stock is, regardless of what people invested in it before. Regardless if your company is worth $47 billion in previous investments, if someone says your stock price is $1 and now your company is worth $1,000, and if everyone agrees, then that's your stock price now. Next slide, please. So I hear you all asking me, so why does everyone care about unicorns? Unicorns are companies that are valued at $1 billion, right? Well, that's actually all they are. They're companies that have been valued at 1 billion, and that's it. So how do you judge if a company is going to perform well if valuation is purely the investment previously made multiplied by the remaining percentages? Well, Alex Wilhelm of TechCrunch, who I really like for this idea, said 100 million in annual rate of return, $100 million in annual recurring return. Sorry, tongue twister there. Meaning that you make $100 million every year recurringly. That's a very good idea, in my opinion. I mean, if you have that sort of capital and you make enough money to support your cost, and you're technically in profit, great. How about enterprise value? That's also a pretty good indicator because it does include your current assets. And a market multiple, saying if someone or a different company in the same space as you has done something great and their values exploded over time, then if you're something similar and you're not in the same market, for example, then the odds are you're going to follow the same path. Next slide, please. Here's the only problem. When an investor invests into a company, be it a startup or an equity or anything else, they have an exit plan. And the exit plan is, I'm going to invest in this company's seed round and then sell my shares at their B round. It's always going to be at that next round. And if you want to make the most between seed and B, you want to get in there first. And if you get in there first and people see you put in that equity investment, it locks in that equity value. And you're back to where we started. If a big investor puts $1 billion behind a company, it's still fairly valued at a low equity price. It's going to attract eyes, and the startup's going to use that most of the time to leverage further investment, with the only goal of riding higher and higher valuations. Like everyone knows, no one wants a down round, and for a lot of companies or for a lot of investors, that's their exit strategy: is pass it on to someone who believes the company is worth more in the long term. And we're right back to where we started. And the final slide, I believe. Next slide. Yeah. So this was pretty much the end of the presentation. I would like to leave it with a bit of a call to action. If you're a startup and you're trying to find investors, do remember one thing: your investor has an agenda as well. It's probably very much aligned with yours because, well, we all want your equity price to go up and we all want to raise capital. And the investor just wants to exit at a higher later price. If you're an investor, don't forget to carry out your own due diligence. This is really key, and I can't stress this enough. It's not just because big company or a bigger bank put a lot of money behind something that they believe in that you have to believe in it too. And maybe it's even too late to get in as an investor. You never know about this. So thank you for listening. This is my part. If there are any questions, I'm still here. I think we've got a couple of minutes left. And I hope it wasn't too academic.
Not at all. Thank you very much, Karim. Very interesting presentation. I'm glad it worked out at the end. Very interesting insights, definitely. You focused obviously a lot of the experience that you've gained, that you've gathered in conversations. Perhaps you could also share one or two of the most common mistakes so that not everybody has to reinvent the wheel, especially in a negative way.
When it comes to addressing investors, and I hear this more often than not, and I also get pitched this quite often, make sure that as an early stage founder, you know who you're talking to, and make sure that you know what their investment strategy and methodology is, because that really is key when you're raising capital. That really is key when you're addressing a market. You need to know who you're pitching. If it's, like I said, an early stage investor, it's going to be all about you as a founder. They don't really care if your idea is great or not, because 3 times out of 5 companies pivot and the outcome is better or worse. But either way, they can't be in love with your idea more than you are. They have to be in love
Okay.
with you.
Right on. Excellent. Okay, good. You're calling from Singapore right now, so perhaps do you have 1 or 2 insights about what's happening in Singapore at the moment? We've been talking about the COVID-19 crisis, of course, but you can also focus on perhaps some entrepreneurial projects or things that you've noticed in the last couple of months or even years.
Sure, absolutely. So Singapore has always been a very interesting marketplace as when dealing with early stage companies or startups or say rapidly scaling companies. The appetites here, the regulatory system is always very supportive. The MAS is always the Monetary Authority of Singapore is always very supportive when it comes to giving out licenses for products that they believe will thrive in this SCA sandbox, which is Singapore. COVID-19, like we all know, it has taken the world by storm. Although from an investment standpoint, I think we were all waiting for something to happen back in November. I'm not sure if this is purely Singapore related or worldwide, but a lot of people that I've talked to have found it very hard to raise capital since late last year, mostly because investors are staying close to their cash and waiting for something to happen. I don't think anyone thought this was going to happen, but it has been a bit trickier to raise capital. So as a piece of advice for all of our young founders out there, now is a good time to reevaluate your cash flow. Now's a good time to trim the fat, make sure that you're lean, and maybe become profitable now. Don't wait for your next raise. Don't wait for the raise after that. Maybe now's the time to prove to your investors that you are a worthy investment right now, and then they'll give you more. But now is a good time to take action.
Excellent. Thank you for that very poignant piece of advice as well. I see that we also have a question from the audience from Omar Khalifa asking, investors usually look for exits, but founders not so much. How does such an inherent misalignment, how has that manifested, and how can you resolve this issue?
Wow. That's a very good question. I wouldn't say it's necessarily fundamental misalignment. In the end, everyone's goal is the same. Yes, an investor wants to exit, but depending on which stage they're investing in you in, their exit more often than not is going to pass it on to another investor who's going to carry you that stretch of the way. And eventually, if your goal is to IPO or get acquired by a giant, one investor will be with you at that stage as well. The idea here is to cruise, per se, with investors in the crest of their desired lifetime or their investment lifetime.
Okay, very good. Thank you very much. We've also had 1 or 2 comments about your slide presentations, and I'll just review what we said at the very beginning of the event today. The entire event has been recorded, so you can happily go back and take a look at Karim's or anybody else's presentation, but we will not be sending out the PowerPoint slide decks individually. You do see, however, on the slide still up on the screen, Karim Raffa can be found at Gmail. He can also be found on his own website. He's got a Twitter account and also a LinkedIn account. So there are literally dozens of opportunities to hook up with him.
Incredibly accessible.
Very good. Karim, thank you very much for your time and the very interesting information and insights. Would like to wish you a very nice evening, though, and thanks for participating in this year's World Innovations Forum Digital Conference.
Thank you, Douglas. Thank you for having me.
Thank you. Bye-bye.